Hey everyone, welcome back to your classroom. I'm Thatcher Taylor, certified financial planner and founder of ProPath Financial. In today's episode, we're diving into one question, but in a bunch of different forms that every retiree needs to understand. Where will your retirement income come from? What a tongue twister. Where will your retirement income come from? And how will it be taxed as it comes out of each location and goes into your bank account so you can spend it the way you want? But this was all created from a post that a client shared with me on Instagram that they thought was interesting. And we got to go through the waterfall effect, the workflow of how this all became what the podcast episode is about, where your income comes from and how it's going to be taxed. And as always, it kind of goes through a fitness lens, but I'll share with you the path that we go through. So before we move on, please make sure to like, subscribe, share. If you think you have anyone that you know of that needs to learn more about their income being taxed in retirement, this podcast, this episode is for them. So let me explain how this all started. Okay, a client sends this to me, a post on Instagram from Jamie Moran, some health guru, something or other. I don't know. But anyway, this is interesting. I'm going to read it word for word. The average American retires at 64 and dies at 76, which isn't completely true. He probably used this date of when people pass away of 76 based off the entire population. So when we're talking about longevity, there's an entire population when people dies calculation, but there's a different calculation that happens once you hit age 65. So of the population that hits age 65, if you make it to age 65, the actuarial tables change. How long you'll live completely changes. But anyway, ignore that. Over half of Americans will spend those golden years, in quotations, living with hypertension, obesity, and reliant on over a dozen prescription drugs annually. Put differently, the average American will spend over 45 plus years, which is kind of, again, he's using weird math now, and nearly 100,000 hours working to save enough to retire in poor health, limited by age, obesity, and illness for about 12 years. Invest in your health, not just in your 401k. That's what really triggered. I shouldn't say triggered. That's not the word. That's what really interested me, was invest in your health, not just in your 401k. That's something that I talk about a lot too. Like when you're working out or you're exercising or you're working on your fitness or your health and your wellness, it is an actual investment. There is a monetary value that can be attached to that effort. So that caught me right at the end. But also, I think he actually made a very good point here. You spend your whole life working and grinding, accumulating wealth, which is predominantly monetary, because it's the first thing on your mind. You got to put a roof over your head. You got to take care of your family. You need food on the table. Maybe you want some vacations. You got to be able to handle all expenses, which is absolutely important. I'm a financial advisor. Of course, I believe in all that. But he makes the point of you work your tail off and you spend the majority of your life up until retirement working for the man, maybe working for yourself. But then you get there and you sacrifice your health along the way. And now you need to turn all these assets into income in a way that supports the remainder of your life. And according to this guy, you're only going to live maybe 12 more years. But if you make it to age 65, the probability of you living to age 85 is extremely high. In fact, there's a 3 in 4 chance. So we're living longer. So then I got to thinking about, okay, so you spend all these years working, and this is usually a question that people pay me to answer. People don't pay me to tell you to be fitter. But people pay me to tell you how to distribute the assets to meet the needs of your retirement. So I thought about this. This hits me. You work your whole life, you accumulate all these assets, and regardless of your health, you need to distribute these assets, whether to pay for your medications or not pay for your medications, or pay for your activities or not pay for your activities. So I thought it would be important to go over the most common places where income will come from and how each one of those segments are taxed, and trying to navigate how to distribute these assets regardless of what your health is. So we're going to spend the next 15, 20 minutes talking about exactly that. Places where your retirement income will come from and how each one of those places are going to be taxed. So without further ado, let's get into number one. And as we go through these, you're going to start to really resonate with some of these because they're going to be most likely the places where you're going to get your income. And number one is Social Security. Now, each one of these segments we're going to talk about. It's going to go what it is and how it's taxed. We're not going to dive in too deep into the details, but I'm going to explain as much as I can so I'm not talking for 2 hours. Okay, first is Social Security. Not all Social Security is taxable, but if your provisional income, which is a bunch of other income, which is taxable income, half of tax exempt income, and half of taxable income, you add back in tax exempt income from like municipal bonds, and half of your Social Security, that's called your provisional income. If your provisional income exceeds thresholds, potentially up to 85% of your Social Security is taxable. So let's just use a brief example. Let's say you got a $100,000 distribution from a taxable source, say an IRA, which we'll get to. That goes on your tax return as income, $100,000 of taxable income. And you're receiving Social Security. Let's say your Social Security is $50,000. If you only received that income, you would think, well, I'm just going to get taxed on that income. And then you receive Social Security. That Social Security, up to 85% of it, which you have exceeded the provisional income limits, I'll just say that, with a $50,000 Social Security, 85% of $50,000 will be pulled in as a taxable event. So you're not only getting taxed on $100,000 of income from an IRA distribution, but now you're stacking on $42,500, give or take, on there. So your taxable income in that year automatically bumps up to $142,500. That's a massive change in the tax ramifications of your Social Security. Social Security is great. It has a role. It's consistent. It's guaranteed. It's inflation adjusted. If you navigate it, it becomes a major portion of your income in retirement. But you need to understand that more income that comes in outside of Social Security will pull more in Social Security onto your tax return in a maximum of 85% of your total annual benefit for that year. So that's number one, Social Security. Number two are tax deferred accounts like traditional rollover IRAs and pre-tax 401ks. Let's assume right now we're just doing pre-tax. We're not doing anything Roth. We'll get to that. Let's assume that all the money in your IRAs, rollover IRAs, SEP IRAs, 401ks is all pre-tax money. That pre-tax money, when it distributes from the accounts, is fully taxable. And let's assume you're over the age of 59 and a half. Let's assume you're over the age of 59 and a half, because anything before there without an exception is going to be penalized too. But let's just not worry about anything before age 59 and a half. Withdrawals add your taxable income, like I discussed in the Social Security example, that can push you into higher tax brackets, which means every new dollar could be taxed at a higher percentage. In addition, when you get to certain ages, 73 or which will be 75 in the future, you will have to take money out and create a taxable event. So you need to plan ahead if you have these account types. Now, this is real income based on the account value, how much you have in there, how it's invested. That money is going to be used for spending, and that is phenomenal. The majority of my clients have a pre-tax account for distributions in retirement, and it works out great. But you got to plan for, because all that money coming out is taxable to you at ordinary income brackets, just like Social Security. That's ordinary income tax brackets, which is the graduated system that we're all familiar with, where most of you 22, 24, 25, 32, 37%, those tax brackets, the graduated system, that's ordinary income that comes out of the traditional IRAs and 401ks. So you need to navigate that really closely. All right, let's just mix in a fun one. Let's just go to some good news. If you happen to have anything with the word Roth in front of it, Roth IRA, Roth 401ks, again, assuming you didn't break the rules, withdrawals from Roth IRAs and Roth 401ks are completely tax-free. After age 59 and a half, and you didn't break the rules, and specifically the rules I'm talking about are the 2 5-year rules. There's 2 5-year rules about contributions and conversions. Let's assume that you're not breaking any of those rules. Withdrawals are tax-free. There's no RMDs for Roth IRAs. As of 2025, there's no RMDs or required minimum distributions for Roth 401ks. And that money passes to heirs completely tax-free. Goes to your spouse tax-free, goes to heirs tax-free. Now you'll have to, the heirs will have to distribute it, not the spouse. The heirs will have to distribute it within a certain amount of time, but it's no longer taxable at any point. So that's why we want some tax diversification here, where what if you're 70 and you need to access some funds for whatever reason? It's nice to have a tax-free source if you can create it. That comes with planning and preparation years before the retirement date. See, that one was pretty fun, which leads us into our next one. I think this is number 4, for pensions. Most pensions, and I literally most pensions, are fully taxable as ordinary income at the federal level. Some states, you got to check with your state. Some states tax pensions, some states do not. But if you have a pension, it's most likely going to be fully taxable as ordinary income. So out of the first 4 sources, Social Security, pre-tax accounts, IRAs, 401ks, SEP IRAs, Simples, 403bs, 457s, those are all going to be distributed and taxable as ordinary income. Roth IRAs and Roth 401ks, you can make distributions, spend the money. You don't have to pay any taxes in any capacity. And then pensions are also ordinary income. Ordinary income is the most taxed state in our tax system, except trusts and estates and those types of things. But those are a standard rate, usually more expensive. But for income, we're receiving money out of accounts. This is our highest tax states, potentially, depending on how much income you have in the tax bracket system. So ordinary income matters. If you have a pension, you need to make sure to navigate how much you're receiving, how long it's going to last, and how any other distributions from other accounts affect those pensions. Some clients, I do have a client that's going to get a quote unquote pension, and it's going to be taxed as capital gains, which we'll talk about in a second. But in general, pensions, ordinary income, affect your tax bill. When you have pensions, you have Social Security, you have distributions from IRAs and 401ks. It all can really add up depending on how you're living in retirement, what your health is like, what your income need is like, what your expenditures, what your activity level is. You can all see how this plays in to distributing more money and creating more taxable events. Basically, besides the Roth, every account that we've mentioned, if you need another dollar, it will be taxed. You need another dollar, it will be taxed. All right, so the next one, to give you a little reprieve, pensions, 401ks, Social Security, if you add another dollar, it's going to be taxed. They're all ordinary income. Roths avoid taxation. But number 5 is a brokerage account, a regular taxable brokerage account, which would be titled as a regular trust account, like a revocable trust, a joint account, an individual account. Any one of those account types are what are called taxable accounts, where they're not technically tax deferred like an IRA or 401k, but they offer favorable tax treatment because the underlying investments that they spit off dividends, which are qualified, let's say they're qualified dividends, they're going to be taxed at a more favorable rate, 0, 10%, and 20%, depending on how much other income you have. You can create long-term capital gains, which are taxed at more favorable rates, 0, 15, or 20%, depending on how much income you have. Unrealized gains on assets within these accounts are not taxed until they're sold. So you have some sort of control. There's no RMDs. There's no taxation unless they're sold. These types of accounts are great for tax efficient withdrawal strategies and flexibility in retirement. Think about what we've already talked about, how all those other accounts, Roth IRA, 401k pre-tax, IRA pre-tax, Social Security, pensions, any extra dollar that you get from those is creating an ordinary income tax, which could be in a very high tax bracket. A brokerage account allows you to access potentially funds that don't create a big or a taxable event at all. It creates that flexibility and control. Now, that doesn't happen all the time. There could be a big gain in the account and you might have some capital gains, but you can navigate that on your own terms. There's no required minimum distributions. So a taxable brokerage account, which may be the most important account type, really helps to navigate retirement by creating a flexible tax situation. If you have non-qualified dividends, then they're going to be taxed as ordinary income, but it's usually manageable as long as you manage the investments properly. All right, another place that you might get income is from an annuity. Now stop, pause. An annuity is just an investment type. It's just a product that's going to be purchased. How that annuity is taxed is based on what type of account type the annuity is. Here's what I mean. Is it a pre-tax annuity? If it's a pre-tax annuity, like an IRA annuity, then that money, when it is distributed, will be taxable as ordinary income. If it's a Roth annuity, which would be weird, I don't see that very often, but if it is, it would be tax-free upon distributions, but don't do a Roth annuity if you're going to do an annuity. It also could be a taxable annuity, like a non-qualified is the term that you might see, annuity, which is what we discussed, where a portion of the money that comes out of there will be taxed. It'll be broken out between your basis and earnings. It depends on the account type on which part of the annuity is taxable. Because remember, the annuity is not an IRA. The annuity is the product within the IRA, although they'll call it an IRA annuity. That same annuity that you purchase could be purchased in a non-qualified annuity, an IRA annuity, a Roth IRA annuity, which is, it just nails on a chalkboard to me. But anyway, you need to just make sure if you're going to use an annuity that you know what type of annuity it is, when it's going to be distributed, how it's going to be distributed, so you know how it's going to affect other taxable events as you accumulate distributions for your income needs. Okay, now we're going to talk about real estate and part-time work. And here's why I'm lumping these two together, or full-time work, is because they are income, but one is passive and one is active. One is passive, one is active in most cases. Rental income is taxable, but you can deduct expenses and depreciation. So let's say you have $30,000 of income from your rental property, but you had $15,000 or $20,000 of expenses or deductions. Only $10,000 of that is taxable to you. I should also mention that if your rental suffers losses, those losses can only be offset against future passive gains. So people seem to think that when they have a rental property and they have a year where they take a big loss in their rental property, that they get to offset their other income with that. That's not the case. That's not the case. You can deduct the expenses and depreciation to reduce down that income that you receive from the passive activity of the rental property. But it all just doesn't fall through to your tax return. Now, if you're more active work, and when that comes over to your tax return, is basically taxing your ordinary income bracket. There's no favorable treatment. Same with any additional regular active work. If you earn money, it's going on your W-2, it's going to your 1040, and that's being taxed as ordinary income as well. This can affect Social Security taxation, Medicare premiums, a whole bunch of stuff. But real estate income is regular ordinary income, and active working income is ordinary income in the eyes of the IRS as well. So here's what I want to leave you with. Your health matters in retirement because it's going to update or change your income distribution strategy. Either way, Whether you're really healthy and you want to live a more active lifestyle or you're going to live longer, you may need to manage your income even better because you're more exposed to longevity risks and increased spending because of your activity level. If you're unhealthy, you still need to navigate income properly because you're going to need to make sure your assets are there to help you through retirement, your medical needs, or if for some reason you do live longer than expected, you need to make sure to have assets on the back end to help out. But having a mix of taxable, tax-deferred, and tax-free accounts lets you control your taxable income each year, because each year is a little bit different in retirement. Sometimes they're the same, but there's a lot of variation. Being able to have different places to pull from to navigate taxes is of the utmost importance. Controlling where your taxable income comes from really helps you reduce your Medicare surcharges called IRMA. It can avoid higher marginal tax brackets, and it gives you more flexibility for Roth conversions, charitable giving, legacy planning. There's a whole bunch of elements that go into this. Elephants? I think I was thinking elephant in the room. That's a Freudian slip. Sorry. A well-built retirement income distribution strategy isn't just about how much money you have. It's about how healthy you are. It's about how you're going to need that money, where it's going to come from, how long you need it, and how it's going to be taxed, because taxation is a major expense in retirement. Managing the tax impact of your withdrawals can make your money last longer and keep more in your pocket. If you need help building plans like this and helping it match the lifestyle or the life that you have, that's where I come into play. You can go to propathfinancial.com, PROPATH financial.com, or you can go to the show notes wherever you're watching this, YouTube, Apple, Spotify, listening to this. You can click the show notes. All my information will be there. Reach out to me directly. I will be happy to chat with you anytime. Thanks for listening or watching. We'll see you next time.